Can you really build a 20 million retirement fund on an average salary? A lot of you might doubt it. If you're on average rate earning say 25 to 30,000 a month in your 20s, it can feel impossible. But here's the secret and an advice I heard from a millionaire mentor when I was in my 20s that stuck with me up to this day. The most important investment in your 20s isn't the stock market at all. It's investing in yourself. Of course, if you can save money in your 20s, the earlier the better, as it has more time to grow. But I think the best investment in your 20s is to learn skills to grow your earning power rather than stressing over building a huge investment portfolio. Your mind, skills, certifications, even side projects, good habits, maybe even switching industries are the most powerful engine that will let you move from a 25,000 starting salary to 50,000, 75,000, or beyond in the decades ahead. And that growing income is exactly what fuels the serious investing you'll begin in your late 20s or 30s. And here's the good news, even when you start at age 30s, you can still retire with millions in investments, enough to provide retirement income and live well during your pension years. If you do get SSS pension, it will be just an icing on the cake. But why is 20 million is the goal? Where does this number come from and why is everyone talking about it? A comfortable middle-class lifestyle in Metro Manila costs around 60 to 80,000 per month. That's roughly 800,000 a year. And following the 4% safe withdrawal rule, you'd need about 20 million in today's pesos invested to fund that lifestyle indefinitely. But with average 3% inflation, the same lifestyle, that 80,000 will not be the same in 25 or 30 years' time. Your nominal target at retirement is closer to 30 million or even more if you factor in inflation. In this video, our plan is to aim for around 33 to 35 million, which is 18 to 20 million in today's buying power. So combining that with a safe withdrawal rate of 4%, 20 million is the real inflation adjusted target. Now, let's start with your foundation era. By 30, many professionals earn around 40 to 45,000 per month. Target savings would be at least 15% of your gross salary. That's 6,750 monthly. Remember, the salaries we use in this video are averages. You may start with the lesser salaries in your early 30s or even more in your later years. Maybe even you have side hustle business or bonuses. I guess what we're saying is any extra income can raise your savings rate and grow your retirement fund faster. But we will model your retirement target by splitting your money into three. We'll set your portfolio growth heavy with 60% in UITFs or global feeder funds, 20% in cooperatives, and 20% in Pag-IBIG MP2. Why we split your money this way? Putting your money in UITFs that tracks the US and global indices like S&P 500 have historically returned 11 to 12%. Is a riskier and more aggressive investment, but because you still have 30 years to compound your money to retirement, you can afford to take more calculated risks. We will use 11 to 12% nominal return, which is an optimistic yet historically supported growth rate. In addition, co-ops give 8 to 10% dividend rates, while MP2 has historically provided 7%. Diversification is important here. MP2 is a very low risk and not tied to the stock market. Co-ops are also low to medium risk that generate steady dividends, but they are tied to local micro business cycles. And UITFs, on the other hand, are aggressive and high risk, and the performance is tied to the global markets. These investments react differently to market cycles, so when one underperforms, the others can stabilize the portfolio. And yes, and consistent investing with this mix through your 30s with 15% of your salary invested will give you around 9 million by age 60, and that's just one decade of savings alone. Now, you reach your 40s. I call this your power decade. This is your prime era where your income rises significantly. Some even get promotions, so by your 40s, income often rises around 75,000 per month. Therefore, you can afford to increase your savings to 20% or 15,000 monthly while maintaining the portfolio mix of 60 UITF, 20% co-op, and 20% MP2. This is where compounding accelerates. You are investing aggressively for another decade, which can add another 12 million to your retirement fund by age 60. Now, in your 50s, this is your time to lock in and protect your income. By your 50s, your income may be a lot higher, but 100,000 monthly income is realistic. Your income is higher and you can save more. But at this stage, many people face higher healthcare and also family costs. If you can save a practical 25% of your income, that's 25,000 a month. At this point, we are gradually shifting to capital preserving. Capital preserving means you can gradually lower your risk investments in the stock market of 60% and move it to a medium or lower risk of 60%, say in MP2, 20% in co-op, and leave 20% in UITFs. This decade focuses on stability. MP2 stocks free, which help lock in gains. Cooperatives continue to provide stable dividends, and a smaller slice of UITFs keeps your investment growing. But even with a less aggressive portfolio, this period can still add around 11 to 12 million to your retirement portfolio. At this stage, your total accumulated wealth is 9 million from your foundation era in your 30s, plus your prime era, you have accumulated 12 million. You add your stability era in your 50s, your total wealth from investments is now 33 million. A 3% long-term inflation or the real returns would look like this. MP2 about 4%, co-ops would be about 5 to 7%, and UITFs would be about 9 to 10%. Combining all decades, the portfolio of 33 million nominal is worth 18 to 20 million in today's peso. And that's meeting the 20 million target even before counting any SSS income. And if you've been working in the Philippines, you receive a social security system pension. But in this plan, SSS is treated purely as a bonus. If you pay the maximum contribution from age 30 to 60, SSS typically provides 18 to 20,000 a month or roughly 240,000 a year, including 13th month pay. That's excellent cash for healthcare or travel, but it isn't required to reach the 20 million real target. Your investment portfolio alone is designed to cover your retirement lifestyle. So if you're an overseas Filipino worker or an immigrant with no SSS coverage, the plan still works. Using the same saving discipline and asset allocation of 60-20-20, this is how much you need to invest to achieve the 20 million target. In your 30s, you need to invest about $110 monthly. That's just over 10% of $1,000 monthly salary. In your 40s, you need to invest $250, and in your 50s, you need to amp your savings to $550 or $600 a month. You can also do the other way, where you invest more in your 30s and in your 40s, but using the safe investing mix of UITFs, MP2, and cooperatives will give you 600,000 or 33 million by age 60. With this, you will have around 1 million a year at 4% withdrawal rate. And remember, this strategy works because of planning early and disciplined investing, not luck. And the easiest way to do this is to automate monthly contribution, reinvesting MP2 maturities and dividends, and ignore the short-term market noise. With aggressive growth in your 30s and 40s, followed by safer compounding in your late 50s, strikes the right balance of growth and protection. And this is not to say that you must split your money this way. There are different investment options like REITs, dividend stocks, that can give you similar or even higher returns. The key message here is to plan your retirement early and carefully. This modeling is just to prove that even simple investments can provide you a nest egg for a comfortable retirement as long as you remain consistent throughout the years, which is easier said than done, but it's very doable. To recap, 20s is the time to invest heavily in yourself, build skills so you can earn more income. By 30s, set up a good foundation with a more aggressive portfolio and increasing your savings rate through 40s. And age 50s and above is your stability and wealth accumulation era. If you're in the UK, I made a separate video on how to save and invest for retirement using the investment platforms available in the UK and how to take advantage of tax-free bonuses from the government. Click here to watch it and don't forget to hit subscribe so you won't miss brand new videos coming up.